Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Larsen Toubro. Let's welcome our guest on the show. Joining us today, Avinash Gorakshakar of Profitmart Securities and Mridul Jalan of Senora Advisors. Many thanks to both of my guests for joining me today. On the show today, we'll analyze the numbers of Asian Paints. It was a steady quarter with the decorative business seeing a lower double-digit volume growth, but the counter is rather soft in today's trade. We discussed L&T's number which met estimates and met the estimates and maintained the guidance for FY20, both on the order front as well as revenue front. The counter is doing well in today's trade. Most of the private banks have now reported the numbers. We analyzed the numbers and asked whether there is any case of accumulating these banks or whether it's an avoid at this point of time. And lastly, we discussed Zee Entertainment, which and whether the worst is over for the company. So that's something that we will discuss in today's edition of Hot Money. But let's start with the first one, and that is Asian Paints. Now, Asian Paints came out with numbers yesterday. Even though the numbers were in line with estimates, the volume growth was strong. Lower double-digit volume growth that came in. But nevertheless, post the numbers, the stock is trading a little bit of headwinds today, so it's down in today's trade. What's the view ahead, and what do you make of the numbers? So, Mridul, I'll start with you. What did you make of Asian Paints numbers?
Numbers predominantly was in line to the expectations. What was surprising was the two parts. One was slightly on the product mix and the fact that the volume growth was in a small double-digit, which is fine because it's a monsoon season. What surprised the market probably was the price action. I think adjusted to the revenue and volume, there was a price decline of 1%, which I think market was not expecting. What it means is that if the crude continues to go up, they may not pass on the crude price hike, which means I cannot put my earning upgrade on the margin side. And we know the economic situation the way it is. So if economic growth headwinds continues, your volume growth will have an issue, your margins will have an issue, and the stock is not cheap. When that is the situation, then some profit booking is possible because the stock is up around 40% in the last 6 months.
Okay.
So that gives a headroom for investors to book profit. And anyways, ahead of budget, investors will want to go a bit light on their books. So for me, this is a normal reaction. I will not read too much into it. At these valuations, I'm not a buyer, but not an aggressive buyer.
So if someone wants to take, obviously Asian Paints is a quality company. Crude obviously has managed to cool off from the highs down almost 5% in the last few days. For someone who wants to take a slightly longer term perspective, would you advise him to buy at this level, or you feel that buying only on a correction would make sense?
So I'll start buying at around 1700, but I will not be surprised if with the market it comes down to 1550 odd. So I'll spread my investments.
Okay, that's the view that's coming in. Avinash, what's your sense? What did you make of the numbers?
No, I think numbers were definitely in line with expectations, but I think obviously lower commodity prices help the company to maintain and slightly improve the EBITDA margins. But I think volume growth definitely was a tad below expectations, and I think the auto business, as a company also mentioned, due to the ongoing kind of crisis in the automotive sector, we don't expect that even the fourth quarter is going to show any dramatic improvement. Our sense is that lower commodity prices are just one element, but the volume growth kicker is something the markets are looking forward to, and that may not happen at least for the next 3 to 4 months. So I think at these levels, Darshan, my sense is we are telling investors to actually hold on, no fresh buying here. Only a correction could offer a good risk reward, and I think as everyone is aware, they have a large market share. So I think this is a more or less a duopoly or a 3-player market. So I think wait for a correction to actually dip in here, but at the current levels one can hold on.
Would that also apply to the other paint companies? If someone wants to play the paint theme, is Asian Paints the best bet, or should they go in for someone else at a cheaper valuation?
I think I would prefer, if one were to look at a choice, I think Asian Paints would still continue to be my number one bet, and second would be Berger Paints. I think Berger Paints has definitely displayed good volume growth and EBITDA margins over the last 2 to 3 quarters, and clearly I think in terms of their reach and in terms of their product mix, I think they could definitely do better in the coming quarter. So I think clearly, even as far as Berger is concerned, I would be clear that it's better to buy on declines, not at the current levels, although I do believe that softer crude prices could actually percolate down into better margins, but the volume growth kicker would possibly take at least 1 or 2 quarters.
Okay, that's the view that's coming in on Asian Paints. I think the consensus view is that wait to accumulate Asian Paints at a lower level. No doubt valuations are extremely aggressive, and there could be more cool off on the stock, and that's the time, if you want to take a position, that's the time you should start to accumulate. The second stock we want to talk about is Larsen Toubro, trading pretty much with positive bias today post the numbers. The numbers, however, were slightly weak, but I think the management commentary on the guidance and them being confident on meeting the order inflow guidance of 10 to 12% and the revenue guidance of 12 to 15% somehow being liked by the street. Avinash, firstly, what did you make of the numbers?
No, I think definitely a good performance in a difficult quarter, and I think the markets like the order inflow in this quarter, about 41,000 crores, and this was a decent 11% growth. And I think the markets were also quite positive on the fact that the management has continued to maintain its guidance of 10 to 12% for quarter 4. So I think markets are definitely looking forward that despite challenges in the macro environment, company clearly mentioning that payments are not coming in time, the working capital ratio having improved from almost 19% to almost 23% for quarter 3. Our sense is that heavy engineering and the infra segment are going to be laggards even on the fourth quarter, and obviously if the company does maintain 10 to 12% growth, that would be a decent kind of growth. But fourth quarter definitely, Darshan, is going to be a very, very difficult, challenging period, considering that working capital constraints continue to hurt the company. So as of now, we have got a market performer rating on the stock. We would not be aggressively buying into it, and probably wait for the management commentary post the Q4 numbers.
Okay, Mridul, what did you make of L&T?
Yeah, so L&T for us is a slightly complex company to understand. Typically, the investors tend to just look at revenue and decide on the numbers. That's not true for L&T. L&T, you have to look at multiple segments. You have to understand from an order book perspective and margin perspective. So while the revenue booking was weak, everything else was quite good. And the revenue booking was weak because of one segment, which is the infra segment. Now, infra segment, nothing is moving in last 3 months. We know that. So practically, that is what is getting reflected in the numbers. The fact that the company continues to have good order book, predominantly from international business, just shows that the health of the company is predefined in terms of focus. Now, the stock has not done much throughout the year. I think it's actually given an underperformance to Nifty as a return, while I need to exactly look at it. What it gives is a conviction to buy in correction, because this is one direct play where if you have to play the economic revival story, one of the better plays after cement is only Larsen. In fact, that's the only play for us. So which means that if the stock is a value, you will see investors at lower level because of the management commentary, and besides the top line number, everything else was fine. So I kind of agree that this stock is a buy at a lower level. I will see it more of a value buy rather than a growth stock at this point of time. For a growth stock or something where you expect a return in 3 to 6 months, Larsen is an avoid.
Okay. You think the management has already said that they are confident of meeting the guidance both on the revenue and order front? If you're looking at it, they need sizable amount of orders to come in into the fourth quarter to meet the guidance. Even on the revenue front, the 9 months they've grown at 10% when the guidance is higher. You think Q4 will be tough for them to meet the guidance? Or will they be in a position to do it?
I will trust the management.
Okay.
That's where I will not say it will be easy for them, but I will trust the management that so close to the quarter end, if they still are confident about it, which means there are pipelines for them. So which is why the market also trusts the management, which is reflective of the price, that even though the bookings were lower this time, some might have got rolled over. So my sense is I will trust the management, but I will not be a buyer for a short term.
Okay, what's your sense on the fourth quarter? You said it will be challenging. You think they will be able to meet the guidance? The management is confident, are you?
No, I think my sense is, I think fourth quarter guidance is going to be challenging. Hopefully, they have a pipeline of orders. I think the order execution, Darshan, is also going to be very important. And clearly, if liquidity concerns persist, which clearly came out from the management commentary that working capital funding has gone up, government is not giving them funding, on time. So I think these are issues which are going to bog the liquidity and the stock. But yes, market is definitely happy about it. I would believe that yes, to a large extent, the market is confident. Even we would believe that this guidance could come in, but then thereafter what happens for FY21 is something which is going to be crucial, because post the budget there are a lot of expectations that infrastructure would get a significant boost and hopefully drive growth for the current year also.
Okay, that's the view that's coming in on L&T. The next stock we want to talk about sorry, is basically the private banking sector. Now, you name the bank, be it a Kotak or be it an IndusInd or being an HDFC Bank or be it an Axis. Most of them actually on the financial side and the asset quality side did manage to disappoint, but most of them have managed to rebound in today's trade. Axis has come off significantly from the day's high, but what's the sense on these banks going ahead? What's the best pick? What is the stock that you should avoid? Mridul, what's your sense now that a sizable number of companies have come out with numbers? Consolidated, you feel that the pain is still there in asset quality. How would you rate this earnings season for banks?
So first of all, we don't paint all the private companies with the same brush.
Yeah.
The way we look at is the private companies, some are large corporate focus, which is like ICICI and Axis Bank. Some are CVs and MFI focus, which is IndusInd Bank, while HDFC Bank and Kotak Bank are retail focused. That is how we define it. Now, if you look at it, HDFC Bank and Kotak Bank have corrected because they have shown lower growth, and they have said that we see challenges in the growth because there could be pain points. Those corrections have come because they were highly valued at more than 4 times price to book. If you say that I will not grow as aggressively, some profit booking will happen. IndusInd Bank, the way they corrected is because MFI has stress. That is clear from all the 5 con calls and management interaction that parts of MFI has issues. Now, post the merger with IndusInd Bank had with Bharat Financials, it's very clear that they have a high weightage to that. And CVs have their own challenges, which is why IndusInd Bank is a avoid for us. Talking about the rest, we really like HDFC Bank, ICICI Bank in that order. And we believe that both will be an opportunity to buy. While ICICI is yet to report a number, typically it's always in line with what Axis reports. So which means the slippages could be a stress, but these two guys kind of are in that valuation zone where the stress is in the price. Don't see immediate upside to them. They will be market performers, but they will not be an outright market outperformer, which they have been over the last 6 months.
But what do you make of the smaller banks? Do you think that this time around they did better? Look at the numbers that somewhat like an AU Finance pulled up and all. Do you think it's time for the market to start shifting portfolios from some of the larger banks to some of these other banks?
We as a strategy remains only in large caps.
Okay.
The way I look at it is, again, which is why we don't paint everybody in the same brush. Each have their own core and segments of growth. AU grows is a different focus part, and the quality is very different. So yes, AU is something which will always trade expensive. But as we see that the more expensive you are, the margin of error is low. So our preference order still remains HDFC Bank and ICICI Bank as top pick in the private banks, and we'll be buyers at every correction there.
Okay, that's the view that's coming in. ICICI Bank and HDFC Bank. What did you make of the earnings season for private sector banks?
No, I think clearly across all the private sector banks, I think one thing was very much clear that asset quality and slippages have increased significantly, and I think this was very much evident in IndusInd Bank and typically even Kotak Bank, where the management has clearly hinted that some further pain points could come in. I think on the retail side, HDFC Bank or typically ICICI Bank, I would also tend to agree that these are banks which have got a more stable kind of portfolio, and probably Q3 could be much better, and even going forward, FY21 could be a lot better because most of the asset quality stress is out. HDFC Bank also reported a slight increase in their asset quality, though marginally, and of course NI growth was very slow in amongst the lowest amongst the last 7 quarters. But overall, if one were to look at a portfolio distribution, I think both ICICI Bank and HDFC Bank, I think Darshan, at declines could definitely be accumulated. I think IndusInd Bank could be a little more volatile, and as far as Kotak and RBL Bank are concerned, I would prefer to wait. I think probably Q4 also could be a little more challenging, and there could be some further price correction.
Okay, that's the view that's coming in on the private sector bank. And the final last stock we want to talk about is Zee Entertainment. Did manage to rally yesterday. Today it's down almost 4%. The last time I checked. Pull up the stock and we'll see what exactly is happening. It's down almost 6% in trade. Numbers not the best of numbers, but I think some bit of positive cues were coming in the con call, which actually has gotten sold into. Avinash, what's your sense on Zee now? Now, most of the concerns are known in the open. It's one of the largest media companies, and now you're getting it at this valuation. Should someone, let's say for a longer term perspective, put money into Zee, or you think it's a big risk putting money here?
No, I think looking at the operational numbers, numbers were definitely disappointing. If you see the ad revenue, the subscription revenue, and the kind of margins which they have registered in this quarter, I think very disappointing. And I think the markets are concerned that compared to the previous quarter, that is quarter 2, quarter 3 also, there have been some contentious issues on the recoveries, on some 1 or 2 accounts. Now, when this money would come back is a key question mark, and I think that is probably the main reason there has been a big overhang on the stock. As far as the pledging factor is concerned, Darshan, now the pledging factor is out, so that is not going to have any reaction on the stock price. But overall, if you look at the operating metrics, I think probably 1 or 2 quarters the going is going to be a little challenge. The new TRA issues are also going to play an overhang on the stock. So I would believe it's going to be a market performer, and anybody who has a very long-term view over the next, say, 12 to 18 months could definitely chip in. Those investors who got a very high risk appetite, because this is a unique business and not many players could obviously manage to mirror it. So clearly, from a short-term point of view, I would avoid it, but from a longer-term point of view, this price looks attractive. Considering that most of the negatives are in the price, and I don't think you're going to see any panic selling now from here on.
Okay, and what's your sense, Mridul? Zee?
In our profile, it's a avoid. It's a clear avoid. While I understand that it has corrected even from valuations in absolute terms from the top, but what you have to realize is over the last 5 years, Zee got re-rated at every interval period of time. Hence, to look at a mean perspective is going to be wrong, because this is the first time after a long gap that you are seeing a FCF negative. And I really don't know if FCF will be positive for FY21 or not. Because if the ad growth revenue doesn't come back, then it's tough for the company. With the investments on G5 and content and everything, while pledge overhang gone has helped the company to be re-rated from 240 odd levels to 300. What we need to understand is 300 is where the deal happened. So if the company doesn't give growth, a lot of people who bought at those levels for medium to long term will continue to start selling. So my sense is 300 to 320 is fairly valued or slightly higher than that, and that is a zone where investors may look for some exit. So both from a fundamental and valuation perspective, Zee is a avoid for me, both in short term and medium term, until as we see some green shoots coming both on FCF and ad revenue growth. That's a parameter we are closely tracking there.
Okay, so that's the view that's coming in on the final stock, that is Zee Entertainment. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests, Avinash and Mridul. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.